Hey everyone, happy Tuesday and welcome back to another Talk Real Estate Tuesdays where I hop live on Facebook and Instagram and go over some relevant real estate information with you. So it's funny because today when I was typing out the title for the episode, I put episode 4 and I had to go back and look and it's actually episode 6. So I can't believe it's already been 6 times that I have done this, but I hope that is providing some value for you all. So without further ado, let's go ahead and get started into today's. So my goal with today's live is to be short and sweet, just kind of a quick summary. Those of you who know me may or may not know that I tend to be very long-winded and I can't be short-winded to save my life, but I'm going to try. So what we're going to do is we are going to talk about, I want to tell you 7 reasons why I am not personally panicked about the direction of the housing market. Okay, so if you are watching live, say hi. If you end up watching later, then drop a hashtag replay. And also, I'd be curious if any of these surprised you or were interesting to you. So let's go here. 7 reasons why I am not worried about where the housing market is headed. Reason number 1. Homeowners have a record amount of equity right now, which is the difference between the value of their house and how much they owe on their mortgage. So in fact, in Q2, home equity in the US hit a all-time record high of $300,000 on average per house, which obviously kind of shakes out differently in different areas in the US, but it is actually at a record high. That doesn't really point to the real estate market being in a bad spot right now. So foreclosure risk is really low when we have homeowners with a lot of equity. Number 2, real estate analysts across the board are projecting deceleration, not depreciation. Deceleration and depreciation are not the same thing. Deceleration simply means that home values will likely continue to go up. Yes, go up, appreciate, but just at a slower pace than what we were seeing the past couple of years when we had really rapid, unsustainable appreciation. So that was great that we had 10, 20% appreciation these past couple of years in some markets. That's not sustainable. So now we're going back down to kind of a more normal level, still going up, but at a slower pace. And that's what most of the big real estate analyst companies are projecting, which brings me to number 3. From 1928 to 2021, the average annualized appreciation on real estate values is 4.2%. So if we look back historically, history shows us, and there's a lot of things that happened between 1928 and 2021, but history shows us that historically, if you're holding on to your property long term, you are going to see appreciation, 4.2 appreciation on average to be exact, which I'll have you know is historically faster than the rate of inflation during that same period. Inflation was roughly 3% during that same period. And so it's always good when we have assets that are increasing in value faster than the price of goods. So number 4, though we've made some progress, inventory does still remain low, which means that there's more demand for homes than there are homes available. Now, if we think of last summer, we know we had a total seller's market. There was just minuscule amount of homes on the market. Now more homes are coming onto the market and we're getting closer to a more even market, though still kind of tilted on the seller's end of the spectrum. So an overvalued market would be one where we have a lot of houses available for that demand. When we have not very many houses available, it's the scarcity that is driving that value up. It's not that it's overvalued. So we don't have to worry there if we look at what that data is showing us. Number 5, real estate values. I thought this was really surprising, but real estate values actually did not fall during 4 out of the last 6 recessions. There was only a slight dip in 1996 during the tech bubble recession. They dipped about 1.9% and then bounced right back. And then obviously in 2008, yes, real estate values fell, but this isn't because the recession caused the real estate values to fall. It's actually the other way around. The real estate estate values falling is what caused the recession. So historically, 4 out of the last 6 recessions, you might be surprised to know that even during a recession, real estate values were still going up. So a recession does not automatically mean that there's going to be a decrease in real estate values. In fact, more often than not, there isn't. All right, number 6. Lending standards now are more restrictive than they were in the early 2000s. If you hear people saying, oh, this is going to be just like 2008, a lot of things have changed since then. The standards are a lot more restrictive. When we look at the data, actually for the second quarter in a row, the mortgage delinquency rate fell to its lowest level since the MBA survey started in 1979. Lowest levels. So again, we're hitting records on the good end of things, really high amounts of equity. We were seeing really high amounts of appreciation. Lending standards are a lot better, so we're seeing really low amounts of delinquency. These are all good indicators that are coming at us, and this is what we want to use to give us some clarity. So lending standards are more restrictive, making it really a lot less likely that we're going to head into some sort of foreclosure crisis. And lastly, number 7, this was really interesting to me as well, but if you take from 1940 to now and you look at any 10-year spread within that time, if you bought a home at market value, your home was worth more than that value 10 years later. If at any period of time, any 10-year spread, 1941, 51, 2007, 2017, if you take any 10-year spread, then the value of the house went up. And yes, that includes during times of recession, that includes the housing bubble. Even then, real estate has been proven to be a great long-term investment. So those are my 7 reasons that are giving me hope and helping me kind of fend off a lot of the doom and the gloom and the opinions that are out there, because I'm a type of person that I always say, go to the data. What is the data showing us? And these are things that the data is speaking to about the real estate market. So I don't think we're facing impending doom. Is it a change? Yes. Is it a slowdown? Yes, because we were going really fast in an unsustainable market earlier. We're just normalizing, and real estate, in my opinion, remains an excellent asset to invest your money in, especially if you're in it for the long haul. So I hope that was interesting to you. Hopefully I didn't go too long. This is my shortest one yet. And I hope you guys have a great week, and I will be back again next Tuesday for another Talk Real Estate Tuesdays. Have a good one. Bye. The awkward pause.